Hello, my name is Gary Kohlenberg. Thank you for visiting our website. I'd like to speak with you today about a Section 1031 exchange. One of the greatest investment techniques ever devised began back in 1921. That was when the Internal Revenue Code included Section 1031 to allow property owners to defer taxes through an exchange. But it wasn't easy, because they had to swap the property they currently own, called the relinquished property, for the property they are acquiring, called the replacement property. Because they had to swap the property they currently own, called the relinquished property, for the property they are acquiring, called the replacement property, at the same time. This was very complicated and impractical. But in 1979, things changed when Starker prevailed in a landmark case called Starker versus United States. I'll tell you more in just a moment. What does Section 1031 mean to you, the investor? Plenty. It means you can delay the taxes you would ordinarily owe when you sell your property for a gain. Normally, you would owe capital gain taxes and taxes from depreciation recapture. Delaying the tax payments to the Internal Revenue Service is like receiving an interest-free loan from your uncle. Uncle Sam, that is. Quite often, Section 1031 of the Internal Revenue Code is misunderstood, and not just by investors. If you ask most real estate salespeople what a Section 1031 is, there is a good chance they will supply you some correct and some incorrect information. The Internal Revenue Service doesn't make it easy to understand, and there are several hurdles you must clear to assure your exchange qualifies. But it's worth it. The following is an excerpt from the Internal Revenue Code of Section 1031. Quote, "No gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind which is to be held either for productive use in a trade or business or for investment." That is so important, I'm going to state it again. Quote, "No gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind which is to be held either for productive use in a trade or business or for investment." The code goes on to further define constructive receipts, boot, basis, timing, and other complexities of a valid 1031 exchange. No wonder people are confused. The purpose of this video is to dispel some common myths about a Section 1031 exchange to help taxpayers make better investment decisions. As always, it is important to review any investment decision with either your real estate attorney or CPA. Myth number 1. The taxpayers must synchronize all components of the 1031 exchange into a single concurrent transaction. This is false. Starker made Section 1031 exchanges easier in the landmark case of Starker versus United States in 1979. As long as replacement property is purchased within 180 days of the sale of the relinquished property, the exchange may qualify if the taxpayer is in compliance with the other rules set out in the Internal Revenue Code. Here's a tip. An ideal situation is to have the replacement property or properties lined up and ready to acquire prior to the sale of the relinquished property. This eliminates a scramble for replacement property by eliminating the stress associated with a ticking clock held by the Internal Revenue Service. Myth number 2. The taxpayer must swap their property to qualify for a 1031 exchange. This is false. It is not necessary to find a property owner that will exchange their property with that of the taxpayers to qualify for a 1031 exchange. In general, a taxpayer may sell their relinquished property to anyone and may purchase qualifying replacement property from whomever they choose. Be aware that these generalities become less clear with related parties, and property outside the United States does not qualify. Myth number 3. A taxpayer doesn't need a qualified intermediary to be eligible for a 1031 exchange as long as the taxpayer has their attorney or CPA hold the cash proceeds from the sale of the relinquished property. This is false. The rules for a valid 1031 exchange require the use of a qualified intermediary if a person or entity has had an existing business relationship with the taxpayer during the past 2 years, they are disqualified from acting as a qualified intermediary. Other persons that are considered disqualified include persons that are the taxpayer's relatives or real estate broker. Considering the significant cash the taxpayer commits to a qualified intermediary, it is imperative the relationship be based on trust, recommendations, and of course, proof of bonding. Myth number 4. To qualify for a 1031 exchange, a taxpayer must replace their relinquished property with a replacement property that was exactly the same to qualify for the like-kind status. This is false. The true measure of a like-kind exchange in the IRS eyes is not an apartment building for an apartment building or a retail center for a retail center. Rather, the rule focuses on the concept that the taxpayer's relinquished property and replacement property be used in a trade or business or for investment purposes. Accordingly, the taxpayer may conduct a like-kind exchange with an office building for vacant land and still be eligible for a 1031 exchange. I hope this short video helped dispel some common myths about Section 1031 exchanges. If you have any questions, please call us at 262-569-1800 or email us at gary@kohlenberg.net. Thank you.